Buying a home is the best financial decision you can make. No, renting and investing, the difference beats buying every single time. You've heard both sides. People argue about this like it's religion. And the truth is, most of them have never actually run the numbers. So let's do it properly. Meet Smith and Martin. Same city, same income, $55,000 a year. Same savings, $60,000. Same goal, build long-term wealth without destroying their lifestyle. Smith decides to rent and invest the difference. Martin buys a home. One of them is quietly building a financial advantage that compounds for decades. The other is falling behind in a way that's almost invisible at first. And here's the problem. Both of them think they're making the smarter choice. But when you actually map this out over time, the gap after 30 years, it's not even close. Hey, I'm Brian. I spend way too much time thinking about how small financial decisions turn into massive long-term outcomes. If you want the highest return on attention you'll get all week, think of this as peer review. Hit subscribe. Because what you're about to see will probably change how you think about housing forever. And we're starting from day one, where everything looks obvious. Smith and Martin start in exactly the same place. They both earn $55,000 a year. They've both saved $60,000. They live in the same city, looking at the same type of home in the same neighborhood. Martin follows the conventional path. He buys a $300,000 house. He puts down 20%, that's $60,000, and takes out a mortgage at 6.5%. All in, his monthly housing cost lands around $1,900. That includes principal, interest, property taxes, and insurance. Smith looks at the same house and walks away. He rents a comparable place for $1,400 a month. No property taxes, no maintenance, no closing costs, just rent. And instead of locking up his $60,000, Smith invests it into a low-cost index fund tracking the market, earning 8% annually. So right out of the gate, Smith has two advantages. He's saving $500 a month in cash flow, and his $60,000 stays invested and growing. Martin, meanwhile, just spent $9,000 on closing costs that he'll never see again. And most of his early mortgage payments are going toward interest, not ownership. Day one, it's not subtle. Smith looks like the clear winner. More flexibility, more liquidity, more momentum. And if you stop the analysis right here, the decision would feel obvious. But there's something Smith isn't seeing. It's quiet, it's boring, and it doesn't show up in the first year. Martin locked in his largest expense. Fixed. $1,900 a month. Today, next year, 10 years from now. It barely moves. Smith didn't. His rent is variable. It moves with the market. It moves with inflation. It moves with everything. That difference matters. A lot. Then there's leverage. Smith is investing $60,000. Martin is controlling a $300,000 asset. Every 1% increase in home value doesn't just grow his wealth, it multiplies it. And then there's equity. Each payment Martin makes chips away at his loan balance. Slowly at first, then faster. It's forced saving. Smith has discipline. Martin has structure. And structure compounds. None of this feels exciting early on. None of it beats watching an investment account grow. But over time, these small structural differences stack. And that distinction over time is worth a lot more than $500 a month. In the first 3 years, the scoreboard isn't even close. Smith is living lighter. He pays $1,400 a month. No surprise expenses. No broken water heaters. No roof issues. If something breaks, it's not his problem. That extra $500 a month, he invests it. His original $60,000 grows at 8% annually. After 3 years, it's worth about $75,600. Add in his monthly contributions, and he's building real momentum. Liquid, flexible, growing. Martin's experience looks very different. That $9,000 in closing costs, gone. His $1,900 monthly payment, mostly interest in the early years. In year one, nearly 70% of each payment goes to the bank, not into his pocket. And then come the extras. A leaking pipe, $1,200. Appliance replacement, $800. Routine maintenance. It adds up quietly. By year 3, Martin has built some equity, but it's modest. Maybe $20,000 when you account for principal paydown and slight appreciation. Meanwhile, Smith is looking at his investment account pushing toward $80,000. He feels ahead because he is. More cash, more control, more visible progress. Through year 3, Smith is winning, and it's not close. Which is exactly why most people stop the analysis right here. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. But something starts to shift around year 4. Not dramatically, not overnight, but enough to matter. Housing prices don't stay still. That $300,000 home begins to appreciate. 3% a year. 4%. Nothing crazy. By year 6, it's worth roughly $347,000. Now pause. Martin didn't invest $300,000. He invested $60,000. But he's benefiting from appreciation on the full value. That's leverage in action. So his equity isn't just coming from paying down the loan. It's being pulled upward by the market. By year 6, Martin is sitting on roughly $78,000 in equity. Smith's investment account? It's grown too. His original $60,000 plus contributions now sits around $95,000. Still ahead, but not by much anymore. And here's the shift most people miss. It's not about where they are right now. It's about where they're going. Smith's advantage is linear. He invests. It grows. Predictable. Martin's advantage is accelerating. Appreciation builds on appreciation. Equity builds on equity. And his largest cost stays fixed while everything else rises. This is the difference between a snapshot and a trajectory. At year 6, the scoreboard is tightening. And the trend from here only goes in one direction. From year 6 onward, the gap doesn't just close, it flips. By year 10, Martin's home is worth roughly $400,000. His mortgage balance has dropped enough that his equity sits around $170,000. Smith's investment account has grown too. It's now worth about $129,500. Still solid. Still respectable. But here's the difference. You can't ignore the cash flow anymore. Smith's rent didn't stay at $1,400. It climbed. Slowly at first. Then consistently. By year 10, he's paying closer to $1,800 a month. Martin? He's still paying roughly $1,900. Almost unchanged. Fast forward to year 20. Smith is now paying around $2,600 a month in rent. Same lifestyle. Same type of property. Just more expensive. His investment account has grown. Somewhere around $300,000 if he stays disciplined. Martin's mortgage is nearly gone. His home value is pushing toward $550,000. And then year 30 arrives. Martin owns his home outright. No mortgage. Just taxes, insurance, and maintenance. Roughly $600 a month. The house itself is worth around $700,000. Smith? He's still renting. That same category of home now costs him about $3,300 a month. Every month. For something he will never own. And this is where the conversation stops being purely financial. Martin has control. His biggest expense is minimal and predictable. Smith has pressure. His largest cost is exposed to the market, forever. One has a finish line. The other has a treadmill. And by year 30, the difference isn't just numbers, it's how they live. Now, this is where most analyses get lazy. Because renting isn't wrong. In some cases, it's the smarter move. If you're in a high-cost city where price-to-rent ratios are extreme, where buying that same property would cost $2,500 a month, while renting is $1,400, renting wins. If you're planning to move within 5 years, buying can backfire. Transaction costs alone, closing fees, agent commissions, can wipe out any short-term gains. And if you're not financially stable, if that $60,000 is your entire safety net, locking it into a house creates risk, not security. Liquidity matters. Flexibility matters. And owning a home comes with real downsides. Maintenance isn't optional. Roofs fail. Systems break. Costs show up when you least expect them. Real estate is also concentrated risk. One property, one location, one market. Smith's path, diversified investments, mobility, lower responsibility. That's not irrational. It's strategic under the right conditions. And Martin's path? It demands stability, time, and the ability to absorb unexpected costs without panic. So no, buying isn't automatically better. But under the right structure, it becomes very hard to beat. Let's strip this down to numbers at year 10. Smith has spent roughly $193,000 on rent over the decade. His investment account is worth about $129,500. That's his position. Martin has spent more, around $285,000 total when you include mortgage payments, taxes, insurance, and maintenance. But he holds approximately $170,000 in equity. So when you net it out, assets minus what's been consumed, Martin is ahead by roughly $50,000. Not because he spent less, but because a portion of what he spent came back to him. And here's the part most people miss. That gap doesn't stabilize. It accelerates. Martin didn't win because buying is always better. He won because of three structural advantages. First, he locked in a fixed cost in an inflating world. Second, he used leverage to benefit from a $300,000 asset instead of a $60,000 investment. Third, he had a forced path to ownership, a finish line that didn't rely on discipline alone. Smith had flexibility. Martin had structure. And over decades, structure compounds more reliably than intention. So this was never really about renting versus buying. It was about exposure. Are you exposed to rising costs or protected from them? Are you scaling your assets or just your contributions? That's the real decision. And once you see it that way, you can't unsee it. Here's the simple question to ask yourself today. Is your largest expense fixed or floating? Because that single variable will shape your financial future more than almost anything else. In the next video, we're breaking down something most people completely misunderstand: the real cost of a mortgage versus the illusion of dead money in rent. And it might flip your assumptions again, because sometimes the biggest financial risk isn't making the wrong move. It's not realizing what game you're actually playing.